You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome to the deep dive. I want you to imagine something for a second.
Okay.
Imagine your AI assistant didn't just, draft your emails or book your flights. Imagine it actively traded its own crypto portfolio to pay for its own server costs.
Right.
Imagine it having its own digital wallet, a credit score, and the ability to negotiate contracts with other machines. And all of this is completely independent of your bank account.
I mean, it sounds like the premise for a science fiction novel, honestly.
It really does.
But it is actually the reality of where financial infrastructure is heading right now.
And that is exactly what we are exploring today. We've pulled together a massive stack of mid-May 2026 tech, crypto, and financial newsletters.
Oh, yeah, it's a deep stack.
Yeah, and there's a very clear mission for this deep dive. We are looking at this hidden convergence, like the collision of artificial intelligence agents and blockchain financial rails.
Because for decades, the global economy has been, a highway system built exclusively for humans and corporations.
Right.
But suddenly, that highway is just being flooded by millions of high-speed autonomous software scripts.
The financial system is literally rewiring itself because machines, not humans, are becoming the primary transactors in the economy.
Which forces a fundamental question, right? What kind of money do machines use?
Yeah.
Because as we're seeing in all the source material, the transition from a human-to-human economy to a machine-to-machine economy, it requires an entirely different type of financial plumbing.
Definitely.
The toll booths we built for human commerce, so credit cards, wire transfers, ACH payments, they're actually breaking under the weight of AI.
So let's unpack the mechanics of that. Because the major payment players didn't just ignore this trend.
No, not at all.
Back in 2025, they saw the AI wave coming, and they really tried to capture it. Stripe launched the agentic commerce, Visa had their agentic ready initiative, and MasterCard, they dropped $1.8 billion to acquire BVNK.
Yeah, massive moves.
But according to the research we're looking at, every single one of those products had a fatal flaw.
And that flaw was assuming you could teach a new machine to use an old tool.
Right.
They were trying to route autonomous agent spending through traditional virtual card credentials. They took an infrastructure designed for a human, typing a 16-digit number into a checkout page.
Which takes forever.
Exactly. And they tried to force high-speed AI agents to use it.
It makes me think of an analogy. Trying to use traditional credit card infrastructure for an AI executing background API calls, it's like using a bank wire transfer to pay for a single grain of rice at the grocery store.
That is exactly it.
You're using this massive, heavy, expensive system for a microscopic action.
That captures the friction perfectly.
Yeah.
Because the AI reality is entirely built on microtransactions. We are talking about fractions of a cent settling thousands of times per minute.
Right.
Look at decentralized AI inference networks like Dolphin Network. They operate on a peer-to-pool model.
Which means they're routing AI compute jobs across idle consumer GPUs all over the world, right?
Yeah, exactly. And they are paying out 20 cents per million tokens processed.
20 cents. Wow. And then there's a Venice, right? Ticker symbol VVV.
Oh, yeah. Venice is a great example.
Our sources note they are capitalizing on this massive 30% global usage spike in Chinese open source models. Venice carried the real training costs, they use cryptographic privacy, and their usage is just exploding, like 50 billion tokens a day.
Right, so think about the sheer volume of individual payments required to sustain 50 billion tokens a day across a decentralized network.
It's mind-boggling. But I'm getting a little hung up here. Why can't Visa or MasterCard just adapt? I mean, they're financial behemoths.
Sure.
Why can't they just lower their per-transaction fees for AI? Or maybe, just tally up all the microtransactions an agent makes over the course of a day and run one big batch payment at midnight?
It's a very logical question, but it comes down to fundamental unit economics and, well, the concept of trust.
Okay, explain that.
Traditional card networks cost roughly 3 to 4 cents per transaction just to operate the network. So below 1 cent, the math mathematically breaks. They lose money on every swipe.
Wow. But what about batching them? Just, running it all at the end of the day.
You can't batch them easily because AI agents operate on real-time, trustless execution.
Trustless.
Right. If an AI agent in New York is buying inference power from an anonymous consumer's GPU in Tokyo, neither party inherently trusts the other.
Oh, I see.
The GPU in Tokyo isn't going to process the job and just hope the AI in New York makes good on a batched payment 12 hours later. They need sub-second settlement with zero chargebacks.
And credit cards just aren't built for that.
Exactly. Credit cards have fraud layers, manual dispute resolution, settlement delays. They were built for trust between humans and merchants, not cryptographic proof between two autonomous scripts.
Okay, so if the credit card rails mathematically break, what is the alternative? Because this is where the narrative in our stack of newsletters really shifts.
Yeah.
The back-end solution taking over isn't a traditional bank at all. It's programmable stablecoins operating on high-throughput blockchains.
Right. Digital tokens pegged to the US dollar.
Specifically USDC. That's becoming the required rail for this new machine economy. The data shows that a Layer 2 network called Base is currently processing 62% of the global on-chain stablecoin volume.
And that specific detail brings us to a massive transformation happening at Coinbase.
Oh, this was fascinating.
Markets have historically priced Coinbase as a consumer crypto exchange, right? A place where retail investors go to buy Bitcoin.
Yeah, an app on your phone.
Exactly. But the data from these newsletters suggests a total paradigm shift. Coinbase is effectively becoming the core financial infrastructure for agentic commerce.
The growth numbers on their Buy 402 protocol are wild.
Yeah.
Over an 18-month period, Buy 402 processed a very modest $80,000. It was just an experiment.
Just testing the waters.
Right. Then suddenly demand shifted. In just 7 days, it processed $3 million.
In a week.
In a week. We're talking about 178.7 million individual agentic payments, totaling $42.4 million in transaction volume. And 99.8% of that settled in USDC.
That hockey stick growth is what we call a demand inflection signal. It shows the market is moving out of the sandbox and into production-grade settlement.
Yeah.
And it's not just crypto-native companies driving this. We're seeing Coinbase's Buy 402 and wallet infrastructure getting integrated directly into Amazon Bedrock Agent Core payments.
So the enterprise world is heavily validating this, and our sources have this repricing Coinbase thesis that models out the financial impact.
Right. Let's look at the McKinsey numbers.
Yeah, McKinsey projects that agentic commerce will be a $7.5 trillion market by 2031.
Trillion with a T.
With a T. The thesis suggests that if Coinbase captures just 20% of that volume using stablecoins, they stand to generate roughly $4.25 billion in annual revenue.
Just from the USDC, float, developer infrastructure, and settlement fees.
It's a completely new enterprise software business model.
It is, but for that volume to move securely, you need new protocols. You can't just send money blindly on a blockchain.
Right.
That's why we're seeing innovations like ERC-8183.
Which was co-authored by the Ethereum Foundation and Virtuals, right?
Yes. It creates a standardized 4-stage on-chain escrow specifically designed for agent-to-agent jobs.
Okay, stop right there, because I want to make sure you and I and the listener really understand the mechanics here.
Okay, let's break it down.
How does a 4-stage escrow actually work without a human middleman holding the money?
Let's walk through it mechanically. Stage 1 is open. Your AI agent broadcasts a job, say, I need this data set analyzed, and it specifies the payment.
Okay, makes sense. What's stage 2?
Stage 2 is funded. Your agent's wallet locks the stablecoins into a smart contract. Think of a smart contract like a digital lockbox on the blockchain that only opens when specific conditions are met.
Got it. And stage 3?
Stage 3 is submitted. The hired agent completes the analysis and submits a cryptographic proof that the work is done.
So neither machine actually has to trust the other.
Exactly.
The money is locked in the box, and the key to the box is the mathematical proof of the completed work.
Right. Which leads perfectly to stage 4, terminal. The smart contract verifies the proof, opens the lockbox, and releases the funds.
Wow.
No bank manager, no holding periods, no dispute resolution department. It happens in milliseconds.
That's incredible.
And crucially, there's a new layer called a privacy hook attached to this, developed by a group called PRXVT.
Which solves the glaring issue of public blockchains. Because if every transaction is public, corporations wouldn't use it.
Oh, absolutely not.
They don't want their proprietary models or private user data leaking onto a public ledger where their competitors can just see what they're paying for.
Right. So the privacy hook enables confidential settlement, keeping the transaction details encrypted while still utilizing the public network for security.
That's a game changer.
But, let's elevate this a bit, because to an average person listening, this might just sound like invisible back-end developer plumbing.
Yeah, that's the million-dollar question. If I'm listening to this on my commute, why should I care that 2 computer scripts are using a 4-stage escrow to trade fractions of a penny? How does this actually change how we interact with money?
Because it redefines the concept of identity and autonomy in the digital world.
Okay.
Alongside these payment rails, we now have ERC 800-04, which is an on-chain agent reputation and identity system.
Right.
And the traditional banking sector is waking up to this. The most shocking piece of news in this stack is about a new entity called Augustus.
Yes. I really want to pause on Augustus.
It's wild.
They just received conditional approval from the OCC to establish a national bank, and they were literally billing themselves as the first clearing bank for the AI era.
Yeah.
We are talking about a federally recognized bank where the primary account holders are not going to be humans with social security numbers, but autonomous AI agents.
That is the implication. Your future AI assistant will have its own wallet, its own on-chain identity, and a reputation score. It will have transaction autonomy. It won't have to ask you to double-click with Apple Pay to approve a server cost. It will hold funds, negotiate with other agents, and execute complex financial tasks on your behalf.
Which introduces a fascinating and maybe slightly terrifying legal gray area.
Oh, for sure.
If an AI opens an account and then accidentally executes a fraudulent transaction, who is liable?
Exactly.
Is it the human owner, the developer who wrote the model, the bank?
Those are the exact existential questions regulators are scrambling to answer right now. Because when trillion-dollar ecosystems emerge, governments notice. The sheer scale is forcing their hand.
Let's look at that scale. Right now, there's roughly $77 billion of USDC in actual circulation, but the on-chain transaction volume hit $21.5 trillion.
Right. And to understand that disparity, you have to look at the concept of transaction velocity.
Which is how fast a single dollar changes hands.
Yes. Because machines operate continuously, 204/7, without sleeping, a single digital dollar might be used to pay for compute power, then instantly traded for data, then used to pay a server cost all in the span of a minute.
So the same dollar is just pinging around the network endlessly.
Exactly. The transaction velocity is vastly outpacing the supply growth, and Treasury Secretary Besant is projecting the stablecoin market cap itself will hit $3 trillion by 2030.
That's a massive influx of capital.
And regulators globally seem to be pulling in opposite directions, trying to manage it.
Yeah, in the U.S., the Senate Banking Committee just released the latest draft of the Clarity Act, which is trying to establish a very strict framework for stablecoin yields and market structure.
Right.
But then, over the UK, the Bank of England is actually softening their reserve requirements. They face massive pressure from the industry, so they are now letting systemic stablecoin issuers hold up to 60% of their reserves in short-term UK government debt, rather than requiring strict, unremunerated central bank deposits.
And we really have to view all of this U.S. regulatory movement against the broader macroeconomic backdrop, right? Specifically, the newly confirmed Federal Reserve leadership.
Right. And just to give you the exact context from the sources, and just laying out the facts here impartially, the Senate just confirmed Kevin Warsh as the 11th Federal Reserve Chair, replacing Jerome Powell.
Right.
It was an incredibly tight 54-45 near party line vote, with only Senator John Fetterman crossing the aisle.
It was close.
Yeah. And the newsletters frame this vote as a reflection of deep, ongoing partisan tension over the independence of the Federal Reserve. A tension that really peaked when the Department of Justice briefly opened and subsequently dropped a criminal probe into the central bank.
It is a highly charged macro environment.
Extremely.
Going into his first FOMC meeting this June, Warsh has explicitly pledged to set monetary policy based on his own judgment, free from White House direction.
And that tension over monetary control is exactly why the regulation of stablecoins is so sensitive right now. But it seems like a sovereign paradox to me. Well, you've got the U.S. pushing the Clarity Act and Europe enforcing MiCA, both trying to rein the space in. But the Bank of England is easing up. Why the differing approaches?
It is the classic innovator's dilemma, but on a geopolitical scale.
Interesting.
Nations absolutely want to control these new financial rails, especially if they are going to settle trillions of dollars in AI commerce, but they are terrified of regulating the innovation right out of their borders.
Oh, because the builders will just move.
Exactly. And if you look at the data, that fear is entirely justified. Polygon, which is another major blockchain network, is currently processing 48% of all non-USD stablecoin volume in the Asia-Pacific region and 69% in Latin America.
Because an AI agent in Singapore doesn't care about U.S. Senate banking rules.
Not at all.
It just routes the transaction to whatever network is fastest, cheapest, and legally compliant in its local jurisdiction.
Precisely. Software is agnostic to geography, which is why building robust institutional-grade environments on-chain is the priority right now, no matter the jurisdiction.
And that leads to a huge question. If we have billions and soon to be trillions of dollars in stablecoins flooding into this machine economy, where does that money sit when it's not being used?
And it is the core issue.
If an AI has millions in idle capital, it's not going to just leave it under a digital mattress. It needs to earn yield.
Right.
Which brings us to the final major piece of the puzzle in these newsletters. Upgrading decentralized finance, or DeFi, to handle institutional capital.
Because up until now, the DeFi lending economy protocols like Aave or Compound, which hold over $10 billion, has operated almost entirely without traditional credit infrastructure.
Yeah, our sources refer to this evolution as the anatomy of credit. Because in traditional finance, you have tranching, credit ratings, credit default swaps.
Right, sophisticated tools.
But historically in DeFi, all lenders in a pool were forced into the exact same risk and yield profile.
Which is a complete non-starter for institutional capital.
Why is that?
Well, a conservative pension fund does not want the same risk profile as a high-frequency crypto trading firm.
Oh, right, of course.
That's why protocols like Cork are so vital right now. Cork protocol is building the on-chain tranching layer.
Let's use an analogy for tranching because it can be dense.
Yeah.
Imagine a massive ship carrying a treasure chest.
Okay, I like it.
Tranching is basically assigning passengers different seats on the ship based on how much risk they want to take.
Right.
The equity tranche passengers, they get to stay in the luxurious lower decks and get the biggest cut of the treasure. But if the ship hits an iceberg, their cabins flood first. They take the losses.
And the other passengers?
The senior tranche passengers are sitting up on the deck in the lifeboats. They get a much smaller cut of the treasure, but they are incredibly safe. Cork Protocol is basically building the software to automatically assign these seats for digital capital.
That is a brilliant way to visualize it. Slicing pools of capital into senior, mezzanine, and equity tranches allows for highly differentiated capital allocation based on risk appetite.
Yeah.
We are also seeing this maturation in how DeFi handles loans. Iris Credit is bringing dynamic fixed-rate lending to the space.
How does that differ from what's already there?
Well, instead of a static interest rate locked into a single protocol, Iris lets solvers manage loan liabilities dynamically across multiple venues. They can automatically refinance and rebalance positions throughout a loan's lifecycle to optimize the cost of capital.
Wow, so it's constantly hunting for the best rate. And then there's the yield generation side, which is just mind-bending. The newsletters highlight Pendle, which generated $44.6 million in protocol fees in 2025 alone by monopolizing the yield-splitting sector.
Yield stripping is fascinating. Pendle takes an asset, for example, tokenized preferred stock, like Strategy's STRC, which pays an 11.5% contractual annual dividend, and they split the exposure.
Walk us through that mechanically. How do you separate yield from the underlying money?
Think of the principal investment as an apple tree and the yield as the apples it grows every season.
Okay, the tree and the apples.
Pendle smart contracts allow you to sell the rights to all future apples. So, the yield token to one investor, while selling the underlying tree, the principal token, to someone else.
That's wild.
By separating those two elements, investors who only want the high-risk, high-reward yield can bid on it, pushing fixed APYs up to 16% and sometimes up to 25% when stacking liquidity incentives.
That completely breaks the old DeFi problem where stablecoins were only paying out like 2%.
Exactly.
You can now build highly sophisticated institutional-grade portfolios on-chain. And it's not just lending and yield. The actual trading infrastructure is getting a massive upgrade. Bye is launching the first PropIM proprietary automated market maker on Base.
Right.
And this solves a notorious issue on Ethereum virtual machine chains, front-running.
Front-running has plagued the ecosystem for years.
Explain how front-running actually happens on a blockchain for someone who doesn't know.
So when you submit a transaction to buy a token on a public blockchain, it doesn't process instantly. It sits in a digital waiting room called the mempool. Predators, these specialized bots, scan this waiting room. If they see you are about to buy a large amount of a token, which will drive the price up, they will pay the network a slightly higher fee to jump in line ahead of you.
Sneaky.
Very. They buy the token at the lower price, wait for your massive order to execute and raise the price, and then instantly sell it back to you at a profit.
It's like standing in line to buy a concert ticket. And a scalper sees you, bribes the cashier to step in front of you, buys the last ticket, and then turns around and sells it to you for double the price.
Exactly the dynamic.
Yeah.
It's called toxic order flow. And Bye solves this by moving professional market makers onto a custom high-performance app chain called Pylon.
How does that help?
It guarantees their price updates hit the top of the block, allowing them to update pricing hundreds of times a second without getting fleeced by those bots in the waiting room.
This level of maturation is so undeniable that even legacy crypto companies are abandoning their original business models to get involved.
Oh yeah, look at MRA Holdings.
Right. They used to be Marathon Digital, one of the biggest Bitcoin miners in the world. They just sold $1.5 billion worth of their core asset, Bitcoin, to fund a massive pivot toward AI infrastructure.
They are reading the tea leaves. They acquired a $1.5 billion energy power campus because the institutional capital is realizing that powering the machine economy is the ultimate growth engine.
But here's where I have to push back a little.
Go for it.
I hear about tranching, corporate yield stripping, proprietary market makers, and AI megacorporations. Are we losing the plot here?
What do you mean?
Are we losing the original decentralized peer-to-peer ethos of crypto if all we are doing is basically rebuilding Wall Street's corporate credit models on a blockchain?
It's a very valid tension, and it's one the entire ecosystem is wrestling with right now. But I would argue that scaling the technology isn't the same as abandoning the ethos.
Okay, unpack that.
If we want a decentralized network to serve as the settlement layer for a multi-trillion-dollar global machine economy, this institutional architecture is a mandatory prerequisite. The alternative is centralized corporate databases controlling all AI commerce.
So we basically have to build the Wall Street tools to prevent Wall Street from owning the network.
That's one way to look at it, yeah. And the ethos of privacy and control is still being preserved, just in new ways. Look at Starknet introducing Strake BTC.
The zero-knowledge wrapper.
Right. It is a zero-knowledge shielded Bitcoin wrapper.
Just to clarify, zero-knowledge meaning what exactly in this context?
Zero-knowledge cryptography allows you to prove something is true without revealing the underlying data. It's like proving you are over 21 to a bouncer without actually showing them your ID or your birth date.
Oh, that's a great way to put it.
So Starknet's wrapper offers completely private balances and confidential transfers for Bitcoin on-chain, but it adds compliance features like viewing keys.
Okay, meaning what?
Meaning an institution can keep their trading strategies completely private from competitors, but still hand a viewing key to an auditor to prove they are compliant.
That is the holy grail. Private on-chain cash that is still auditable.
And we are seeing similar standardization efforts with Route 66, which is an initiative co-led by Commonwealth and Coinbase to build shared standards that drastically cut the cost of integrating new blockchains. Mass adoption simply requires standardization, privacy, and institutional risk management.
All right, let's step back and look at the big picture here.
Sure.
The AI revolution we've all been reading about is not just about smarter chatbots writing your emails. It is fundamentally about autonomous economic agents.
Absolutely.
And as we've explored today, these agents have looked at our traditional credit cards, our human toll booths, and completely rejected them.
They mathematically break.
Right. They require programmable, high-velocity stablecoins settling in fractions of a cent on blockchains. We are seeing Coinbase transform into agentic financial infrastructure. We're seeing regulators wrestling with how to capture this market without stifling it, and DeFi is putting on a suit and tie to handle trillions in institutional credit. The entire financial plumbing of the world is being aggressively upgraded.
The transition is happening right beneath us. The machine economy is here, and it is demanding its own monetary standard.
Which leaves us with one final thought for you to ponder. We started by imagining your AI assistant trading its own portfolio and paying its own bills.
Yeah.
But if these autonomous agents now have their own federally recognized crypto wallets, their own unique on-chain identities, and direct access to Goldman Sachs-level decentralized credit markets,
It's coming.
how long until your personal AI assistant has a better credit rating and a vastly more sophisticated investment portfolio than you do?
Now, that is a truly fascinating question to consider.
Thanks for joining us for this deep dive. Keep questioning the systems around you, especially the ones being rebuilt right under our feet. We'll see you next time.
Spoken Tech for your ears.